If you like making income through options trading, then you are going to love the Iron Condor. You can start out with as little as just $100. You can bet on the stock going in any direction, and you can get about twice the returns that you would see by using spreads. Welcome back to Everything Options. My name is Greg, and today we're going to be talking about the Iron Condor option strategy. So to break this video down for you, first we're going to talk about the basics behind the strategy, followed up by 2 real examples today. And finally, at the end of this video, as always, we're going to talk about the risks associated with the Iron Condor, because with any option strategy, no matter what you use, you can always lose money. But before we get into that, if you learn anything out of this video, or if you just enjoy it, make sure to show some love, leave a like, and let's get into it. Iron Condors are one of the few strategies that allow you to bet on a stock going in any sort of direction. It can go up, it can go down, it can even trade sideways, but you have to be on the right side of the Iron Condor, because with any coin, there's always 2 sides to it. You have the short Iron Condor, and then you have the long Iron Condor. We're going to talk about the long Iron Condor first. And the way that a long Iron Condor works is you're assuming that the stock price will be either above your call strike prices or below your put strike prices. So we're going to start out by selling a call option with a strike price that we think the stock price will be above on our expiration date, and then we're going to sell a put option with a strike price we think the stock price will be below on our expiration date. But this alone would cost us a lot of money, because we'd have to have 100 shares of the stock to sell the call option. Then we'd have to have enough money to buy 100 shares at the put strike price as well. Instead of putting up all of this money, what we're going to do instead is buy a call and a put against those that we sold. And in order to make this a long Iron Condor, we need to make sure that we pay a debit in order to open this trade. So in order to ensure this, we need to buy a call option that's more expensive, and we need to buy a put option that's more expensive than the calls and the puts that we sold. The lower your strike price for a call option, the more expensive it's going to be, and the higher your strike price for a put option, the more expensive it's going to be. So we're going to buy a call option with a lower strike price than the call option that we sold, and we're going to buy a put option with a higher strike price than the put option that we sold. All in all, we're going to end up paying a debit, since this is a long Iron Condor, and that debit is going to be the max risk that we take on whenever we open this. We can only lose as much as we put into this trade. And if we're right on our assumption and the stock price is either above our call strike prices or below our put strike prices, then we're going to take away our maximum profit, which is going to be equal to the difference between your strike prices for the calls and the puts. If they're the same, you're going to multiply that difference by 100, and then you're going to subtract the debit that you paid in order to open the trade. So for example, if I think that XYZ stock is either going to be above $105 or below $95 on its expiration date after some big event that I'm expecting, I'm going to start out by selling a call option at a 105 strike price, buy a call option at the $104 strike price. Then we're going to sell a put option at the 95 strike price, and then buy a put option with the $96 strike price. So the difference between our strike prices for the calls and the puts is $1. We multiply that by 100, and then we'll subtract the debit that we pay in order to open all of these options. So let's say that I pay $30 in order to open this trade. If I'm right and the stock is either above 105 or below $95 on my expiration date, then we'll take the $100 from the difference between the strike prices on the calls and the puts, subtract the $30 of debit that we paid, for a maximum profit of $70. But the maximum loss for this trade, if the stock price is between our strike prices for the call option and the put option that we bought, so 104 and 96, then we're going to take on our maximum loss, which is going to be equal to the debit that we paid, again, which was $30. And then you also have the break-even prices. So if the stock is between 104 and 105 on your expiration date, your break-even would be 104.30, 104 plus the $30 of credit. And then if the stock is between your put strike prices of 96 and 95, your break-even would be 95.70, or $96 minus the $30 of debit that we paid to open the trade. So hopefully this all makes sense to you. Now let me bring it all together with expiration dates. Now, the expiration date that you choose is ultimately going to be up to you. Usually, this is going to follow some major catalyst, say an earnings report, or if some product reveal is coming out that you're assuming is going to make the stock move in a big way, then you can use the long Iron Condor around these certain dates. And the further that you put your strike price out for the long Iron Condor, the more that you're going to pay in order to open your trade, but the more that you're going to put the odds in your favor. Think of it this way. Is it more likely that a stock is going to move up or down 10% in a week, Or is it more likely that the stock is going to move up or down 10% over the course of a year? Obviously, it's more likely to move bigger over the course of a year. So in this case, you're going to end up paying more for your long iron condor since the odds are further in your favor. And that's the basics behind the long iron condor. Again, we want the stock price to be either above our call strike prices or below our put strike prices on our expiration date. But again, there's two sides to every coin. On the flip side of the coin, if you don't think a stock is going to move hardly at all based on some sort of upcoming catalyst, then you can use a short iron condor. And the way this strategy works is you're going to start out by selling a call option at a strike price that you think the stock price is going to stay below on your expiration date, and then sell a put option at a strike price that you think the stock price is going to stay above on your expiration date. So we're selling a call option and a put option, but we don't have enough money to buy 100 shares, and we don't own 100 shares of the stock. So we're going to have to buy a call and a put against these options that we sold. In this case, with the short iron condor, we want to make sure that we receive a credit. So in order to do this, we need to buy a call option and a put option that are cheaper than the ones that we initially sold. This means with a call option, we need to buy a higher strike price, and with a put option, we need to buy a lower strike price, because the higher your strike price for a call option, the less intrinsic value that it's going to have if it's in the money, and if it's out of the money, it's less likely that the option will expire in the money. And with a put option, the lower your strike price, the cheaper the option is going to be. So to recap here, we're going to sell a call option at a strike price we think the stock price will stay below on our expiration date, buy a call option with a higher strike price against the one that we sold, and then sell a put option at a strike price we think the stock price will be above on our expiration date, and then buy a put option with a lower strike price against that put option that we sold. For example, if XYZ is trading at $100 and they have their upcoming earnings report, and I don't think that it's going to go above 105 or below 95 on my expiration date, then I'm going to sell a call option with a 105 strike price, sell a put option with a 95 strike price since I think it's going to be above that, and then we're going to buy a call option with a higher strike price than the 105 call, so we'll buy a 106 call against it, and then buy a put option with a lower strike price than our 95 put that we sold, so we would buy a 94 put option. We're only going to put up $100 of collateral in order to open this trade, since the difference between our strike prices for our calls and our puts is just $1. We're going to multiply that by 100. And then in order to come up with the cash that we're putting down of our own in order to put on this trade, we would subtract the amount of credit that we're getting in order to receive this trade. And that's the total amount of risk or the max loss whenever we open these options. Again, we should end up getting paid a credit in order to open these options since we're going short on an iron condor. And this is one of the best ways that you can make income through options trading, because this is basically the equivalent to having a put credit spread and a call credit spread. So basically you're getting double the amount of credit that you would by opening just one of these, but you have to assume that the stock price is going to trade flat between your strike prices on your expiration date. And I think right now might be the perfect market in order to start using iron condors. My assumption right now is over the next few months, the stock market isn't really going to go much of anywhere. We're not in this giant bull rally like we saw in 2020 and 2021. We don't have the Fed having zero interest rates anymore. They're not supplying the markets with infinite money. But I also don't think that we're going to be bearish, because I don't think the Fed is going to be willing to step it up to raise interest rates to the point where we actually need them in order to curb inflation. So we're kind of in this pickle where I'm expecting the stock market to do a whole lot of nothing. And this month I was able to make profit on this thought process of about $150 so far. And by the end of the month, I'm hoping to make about $250 based on just $1,000 that I invested for these options. So that's a 25% return over the last month, even when the stock market really hasn't done much of anything. In fact, it's actually fallen over the last month. So I made profits even in a bear market. And if you want to follow my trades in real time, I post all my trade alerts to my premium Discord. You can find that down in the pinned comment below. Anyway, we talked about strike prices, and the other side of this equation is going to be our expiration date. Now, usually you want to set the expiration date for after some major catalyst, because that's when you're going to get the most amount of gains from implied volatility. But earnings season right now is kind of wrapping up. So we're going to want to extend our expiration dates to 30 to 45 days out in order to capture the most amount of value based on time decay. In an options life cycle, the last 30 to 45 days is when they lose the most amount of time value. So this is going to be the best time to short these options with a short iron condor. And to really drill the strategy down for you, let's go through an actual example for the short iron condor. So like I said, I'm expecting the overall market to trade pretty flat over the next few months. So what we would do on that assumption is go to the option chain, set our expiration date between 30 and 45 days out. Today is February 6th, so we'd set our expiration date for at least March 7th, right? But we want to choose a monthly expiration date, the third Friday of the week, just for liquidity purposes, because getting in and out of these trades will be harder with weekly options than it would be with monthly options. So we're going to set our expiration date for March 18th. So it's going to be towards the top of the range for a 30 to 45 day till expiration, right? And then we're going to start by finding a call option with a 20 delta. This means that this option has about a 20% chance of expiring in the money. And I've already looked at this earlier. The 470 call has a 20.07 delta. So we would sell this call option in order to open it with the short iron condor. And then we would buy back a cheaper option. So buying back the 471 call above it. And then we'll go to the put option chain, scroll down to find an option with a negative 20 delta, since put options will have a negative delta. And again, I think I've already looked at this, and it was a 417 put that had a negative 20.26 delta. So we're going to sell this put option in order to open it. And then we're going to buy back a put option with a lower strike price. So this way we'll get a credit because the 416 put is cheaper than the 417 put. So our assumption here is that we think SPY will be between our 470 call strike price and our 417 put strike price. So the options that we sold, we're assuming that the stock will be between those two strike prices on our expiration date, in this case on March 18th. And if we're right, we're going to get $370 of credit for a 37% return over the next 5-6 weeks, which is pretty dang good. But if we're wrong in this trade and things go south on us, say if SPY goes up a ton past $471, then we're going to take on our maximum loss of $63 per option. And if we open 10 of these, that'd be $630 of loss. And that would be the case also if SPY falls past our $416 strike price. We would still lose $630 if we were to open 10 of these. And that's what I've been doing, over the past month, is opening these iron condors. And last time, I think I got like $260 of credit, and the expiration date was 30 days out. But since we're extending the expiration date a couple more weeks out, it's giving us a little bit more credit, $37 of credit per option. And if we open 10 of these, that would be $370. So again, 37% return if we're right. But if we're wrong, we'll lose, $630. And then you also have the break-even prices, which would be the 417 strike price minus the 37 cents of credit that we get, or the 470 strike price plus the 37 cents of credit that we're getting. So if SPY were to end up between 470 and 471 on our expiration date, then our break-even would be 470.37, and if the stock were to be between 416 and 417, our break-even would be 416.63. But that's if we think that SPY will trade flat. Maybe you're on the other side of the coin and you think that SPY is going to see a big move, maybe based on the upcoming Fed meeting in March. So what you could do if you don't agree with me is clear this trade out. We're going to go to the call options, and we're going to start, again, with a $470 strike price like we did before. But instead of selling that option, we would buy that option for $262. We would sell the 471 call above that. That's going for cheaper because it has a higher strike price. Then we would go to the put option chain, scroll down the option chain again to find a 417 and 416 strike prices. So in this case, we would end up buying the $417 call, selling the $416 call. So you're taking on the opposite assumption that I had, believing that the stock will either be above $471 on my expiration date or below $416 on our expiration date. So in that case, you have the opposite risk to reward profile, to where this option would cost you $37 in order to open it. So if we open 10 of them, that would be $370 cost. But if we're right, and the stock is either above 471 or below 416 on our expiration date, we would make $630. But if we're wrong and SPY is between our 470 strike price and our 417 strike price, we would lose $370, the debit that we put into this trade. And then again, you have the break-even prices, which are the same as we had before at $416.63 and then $470.37. And that is your examples for the long iron condor and the short iron condor. So hopefully that helped you. But now we have to talk about the risks that are associated with the strategy. The risks that come along with the iron condor are like with any other type of spread. Since you're going long on one option, or actually two options, and then you're going short on two other options, you run the risk of early assignment. This just means that the buyer that bought the options that you sold can exercise their options early if they decide to. Usually this is going to happen when your options have little to no extrinsic or time value that's left in them. So usually this will be an option that's deep in the money with maybe a week or two until the expiration. That's when you're most likely to get assigned early for an option that you sold. And whenever this buyer decides to exercise, you're going to end up being assigned, which means that for a put option that you sold, you're going to have to buy 100 shares of your stock at the strike price that you chose. And then if you sold a call option, then you're going to have to sell 100 shares of the stock at the strike price that you chose for your call. Now, this would cost you a lot of money, of course. And since this is a small account strategy, you don't want this to happen to you. So what you can do in order to balance this out is exercise the option that you bought. So if you get assigned on a call option, you can exercise that call option that you bought against the call option that you sold, and this will balance out the trade. So if I got assigned on my 105 call, I could exercise the 104 call, buying 100 shares at my 104 strike price and selling 100 shares at my 105 strike price. My brokerage is going to end up taking care of this trade for me since this trade balances itself out by buying and selling the 100 shares. Now, this is good if you're on the long side of an iron condor. This would actually generate maximum profit, and you'll get to realize this early since this is ultimately an early assignment. But if this is a short iron condor, then you're going to end up taking your maximum loss for this trade since you got a credit in order to open it. And with the short iron condor, we would have sold the 104 call and then bought the 105 call. This means that we would have to sell 100 shares of 104 based on selling the 104 call and then buy the shares at 105. So we end up taking our maximum loss. You can be assigned on the put side of an iron condor too. And that's it for early assignment. But there is another risk that you should definitely be aware of because this actually can't be fixed if this happens to you. And that is when the stock ends up between your strike prices for your calls or your put options on your expiration date. This is going to leave one of your options in the money. The other option is going to be out of the money. So this means that the one that's in the money will either be exercised or assigned. And then the one that's out of the money can't be exercised or assigned since it has no intrinsic value. It doesn't make any sense for this option to be exercised. Say if you bought that 105 call that we've been talking about and it expires out of the money where the stock is below $105, say it's at 104.50, why would it make any sense for me to agree to buy 100 shares of the stock at $105 when I could go to the market price and buy them for 104.50 and get a discount? Clearly, it doesn't make sense. So if your option expires out of the money, then it's going to be worthless. But the one that expired in the money is either going to be exercised or assigned to you. So say we sold the 104 call in a short iron condor, we would have to sell 100 shares at the 104 strike price. But since our 105 call expired out of the money, we can't buy the 100 shares at the 105 strike price. So we're going to be short 100 shares of this stock at the 104 strike price and have to sell them at the 104 strike price. So we would have to buy the 100 shares with our own money at 104.50 if it's at that price, and then sell the 100 shares at 104. And we don't have enough money to buy 100 shares of the stock. That's why we're using iron condors. This is a small account strategy. So this means if you're afraid of this happening, you need to close your options before they expire to avoid this altogether. Because if the options don't expire and you sell them or close them before they expire, then you don't run this risk. You can always exercise an option early with early assignment. If you were to get assigned on the option that you sold, you can exercise the option that you bought. But when it comes to your expiration date, there's no exercising the option that you bought if it's out of the money. So again, close these options before they expire if you assume that the stock price could be between the strike prices for your call options or your put options, and you don't have enough money to buy or sell 100 shares of the stock. That's the easiest way to avoid this risk. And that's all the risks that I have for you on the Iron Condor, and that wraps up the strategy. So hopefully you learned something from this video, and hopefully you can make some money with this strategy. Thanks for making it all the way to the end of this video, and thank you to all my patrons for their support. And as always, remember to stay positive, stay green. I'll catch you in the next one. Bye, guys.